How do you
hmm
evaluate a deal to know, yeah, there's a ton of potential here, and then are there certain like red flags that you watch out for, that sort of thing?
There's a ton in every deal. We started out with a 50 item due diligence checklist, and that was, geez, about 9 years ago. And now today, our due diligence checklist is over 350 long, 350 checkpoints long,
Wow.
because we've learned something from every deal. And utility infrastructure is really important when you're looking at a mobile home park. I think above everything else, I mean, it's probably the market, like where you're buying, right, is really important, because you don't want to buy in a one horse town. In my early days, we bought a park where there was one employer, and that one employer was a Smithfield Farms, Smithfield like meat manufacturing plant.
Mm-hmm.
And during COVID, that plant shut down.
Ooh.
So all of our tenants were just like, they had no income. They were completely shut down because it was just that one horse town. It was a small town in Northwest Iowa. So long story short, market's really important. Don't buy in a ghost town. And then the other piece would be, hey, look at the utility infrastructure, because that's really what you're buying. All of our tenants in our parks own their own homes. So
Mm.
they maintain them. They're responsible for repairs and maintenance. And, what we're buying is the land and the infrastructure, the roads, the fencing, the signage, the utility infrastructure. And the utility infrastructure is the most expensive part, to replace all the sewer lines or replace all the water lines, is really expensive. So that's, what I would look at if you're interested in looking at this. And then, all of our parks are over 50 lots. That's what we're looking for, is to get enough scale now, partner together with a group of people, and everybody puts in, say, 100,000, and then we'll co-own the mobile home park as a group, so that we have more scale. So that if we lose, one tenant, we're still cash flow positive. We have 49 others to help us, make our mortgage payment. So I think that scale really helps, build the cash flow and the consistency and reliability of it.
Got it. Okay. Yeah, and when you think about mobile home parks, typically you kind of think, more affordable housing, lower income, typically. How do you ensure that you still get paid the lot rent? Like, what happens? Like, do you screen people who are buying these units, and then what happens if they decide not to pay the lot rent? How does that work?
Yeah, so that's a really important aspect of it. So we definitely screen them, looking at income, looking at criminal, background checks, credit checks as well. So we are screening them. If someone does not pay us, which I think a lot of people think, oh, geez, you're probably chasing 50% of your tenants every month for rent. They'd be surprised to hear that across our 3,000 mobile home park lots, 5%, we collect
Wow.
95%, by the 10th of the month. But then that other 5% is where the extra work has to come in. We're following up with them. We're pursuing them. But again, it's only for 5%. It's not like 50% of our tenants need to be chased around every month.
Yeah.
Upon non-payment, there is a lot of leverage to the landlord. Now, every state's a little bit different. In the red states, the more landlord-friendly states like Indiana, it takes about 30 days to evict the tenant, right? And then after that, if they owned the home, it takes about another 30 days to file for abandonment on the home and to get the title to that home. So about a
Mm.
60-day process. Then we'll get title to the home. We'll own the home. We can come in and renovate it and get it, sold again, or do what we want with the home. But it does take a little while to file for abandonment and get the title in our name. And a lot of times we're cutting deals with the tenants. We're doing cash for keys and trying to just say, hey, you're getting evicted. You've been evicted. Hey, we'll pay you $1,000 for this home, and just give us the title. And at that point, they're happy to have that $1,000 to use as, a deposit for the next apartment they go rent or whatnot.
Got it. Okay. So the eviction process works pretty similarly, it sounds like, to owning, like an apartment unit or something like that, other than, the abandonment portion where you have to take over the actual home itself. But to get somebody evicted after not paying the lot rent, it's pretty similar.
Very similar.
Got it.
Yep, exactly.
Cool.
Yep.
Interesting. And we just had somebody recently on who buys RV parks. Is Does it work similar to that, or do you own some of those as well, or is it kind of synonymous, or is it a very different model?
It's very similar, right? Because it's personal property. It's like a vehicle, right? That's on your land. There's a title, like you have a title for your car, for RVs, and for mobile homes. Now, the big difference is the reliability of the income, right? In
Mm,
RV parks, obviously it's a destination type of thing, but in the middle of the night, they can get those RVs, and just pull them out,
yeah.
right? Like it's a very quick, easy process to pull an RV out of a park. Well, for a mobile home, it's not such a quick, easy process, right? These things are block leveled, tied down. Utilities are hard hooked in. It's not like they're just a plug you unplug like in an RV. These are like hardwired into the manufactured home. So to move a mobile home, even just down the street, just a couple miles, may cost $5,000 to $10,000,
Mm,
depending on the
wow.
home and the age of it. And it's not just a very quick, easy process. So I think another differential from RV parks is the financing available, right? There's better financing available for mobile home parks, manufactured housing communities, for the fancier way to say it, because it's a more sticky tenant base. The turnover rate is only around 5% annually because the tenants own their homes. They stay longer, where RV tenants are less sticky. There's more turnover. It's more of an operational intensive business than it is, a long-term real estate. But both can be very successful. They're just, it's important to notice the differences.
Yeah, that's a great point. And I was going to ask you about financing because, I mean, do banks do typical like commercial investing loans or commercial real estate loans on RV parks? Or, I mean, on mobile home parks?
On mobile home parks, they do.
Yeah.
Yeah. So we'll go in our model is we'll go with a local, regional bank typically to
Okay.
buy the mobile home community from a mom and pop owner. We're cold calling, building relationships with the owners and buying these direct from the owners. And we'll buy with, 75% loan to value, interest rates right now around 7%, 25-year amortization, and, typically a 5 to 7 year balloon, where it's a fixed rate for that period and then it will balloon. So that's a typical commercial deal. And then what our model is hey, we're going to go in, we're going to raise rents, we're going to fix it up and fix the roads and fill the vacant lots. And then we're going to go and refinance into the best financing offered to mobile home parks. And that is through the agency lenders,
Mm,
Fannie Mae, Freddie Mac. And so we're going to refinance into a longer term 10 or 12-year debt facility that is the best financing available, non-recourse, 75% LTV. Rates are the lowest you're going to find. And, these are longer, loans that are more, permanent financing. And it's basically the government is promoting investment into affordable housing, and this is one way that they're doing that is offering good financing. Now it comes with requirements, right? Like the park has to be 90% occupied or more. You have to make sure that there's no deferred maintenance. They send an engineer through and do an inspection of your property and require certain repairs be done. The roads need to be, paved and in good shape. So, there's strings that come with those loans. But that's our whole model is buy, one that's been kind of mismanaged, fix it up, and then get it into the agency financing long term and then hold it long term for the cash flow.
that makes sense. So it's like the Burr model for mobile home parks, really.
Exactly.
Can you share maybe an example of an ideal deal? Like how much value do you add by fixing up, the infrastructure, filling in some of the vacant lots? What's maybe what's an example of one that you've recently done?
Totally. Yeah. So let's say you have an 80 lot park and there's only 65 occupied, right? So there's 15 vacant lots and, let's say lot rents are $450 a month, which is very similar to a deal we're looking at buying right now outside of Atlanta, Georgia. So to get the value of an occupied lot, you take $450, which is the monthly lot rent, times it by 12, which gives us $5,400 in gross. Now, the expenses typically on a mobile home park are around 35%.
Hmm.
And that's if it has public utilities, city water, city sewer. There's some mobile home parks that have, well water and wastewater treatment systems and lagoon systems. We stay away from those because there's additional expenses and requirements and testing and so forth. But 35% for a public water sewer system is very normal. So we take that 5,400 times 0.65 to reduce it by the 35% for expenses to cover taxes, insurance, management, maintenance, things like that. And we get an NOI of $3,510, right? So take that, divide that by a 7 cap, divide it by 0.07. That means the value of an occupied lot is worth $50,142 and some change. So the value of an occupied lot is worth $50,000. So we're talking about a park that has 80 lots. There's 65 occupied and 15 vacant. On average, it costs us around $25,000 to buy a used mobile home and bring it in, get it set up, install the skirting, install the steps, get the utilities hooked up, and all of that. So $25,000 times 15 vacant lots, we're gonna spend $375,000 to fill those 15 vacant lots. And then what we've just done to spend $375,000, now we're doubling our money in terms of the value, because the value of an occupied lot is $50,000. So we've just added $750,000 worth of value to this mobile home park by buying this community, this 80 lot community, filling up. Affordable housing is desperately needed in most markets. So those 15 vacant lots were not providing housing, right? So now we've added 15 affordable housing units to the market, and we've doubled our money. We spent 25 grand to make 50 grand per lot on those 15 lots. And then, the other side of this is, with inflation, we're able to increase our rents typically every year around, 5 to 6%. So that's 80 lots. If you just raise rents, $30 per year for 3 years, the value of 80 lots times $30 times 3 divided by 0.07 for a 7 cap is over $1 million.
Wow.
So if you own an 80 lot mobile home park and you just keep it full and you raise rents $30 per year for 3 years and do nothing else, the value of that mobile home park will go up by $1 million.
Wow.
And then you can go, you can sell it and pay taxes on it, or you can refinance where you don't have to pay taxes on it, and you can capture some of that equity you've created, pull out the money you put in, and go do it again. And that's what we do.
Yeah. That's incredible. And I appreciate that breakdown. And that's in addition. So you've added that $1 million in value in addition to collecting cash flow. It sounds like it's pretty high cash flow on a monthly basis as well, correct?
Exactly. Yeah. So if the 65 lots, obviously there's 35% expenses, but there is some very good cash flow because there's less repairs and maintenance. I think from when I owned some single family properties, it was I would put my 25% down. I'd buy a single family home and rent it out, and once a year I'd have this big capital expense. Right, something would break, and I would need to come fix it. Whether it was a roof repair that would be needed, or you name it. Right, plumbing repairs. Other various things. The gutters would fall off the back of the house, and I'd have to invest, money back in that CapEx money back into that property, and eat up a lot of the cash flow. Where, in a mobile home park, you're spread out across so many more tenants. It's not just one home that, could kind of take you to zero really quick. You're diversified across several tenants. And I think that aspect, makes it a little bit more attractive.
Yeah. And I think, like you mentioned in the beginning, a lot of people have seen examples of mobile homes that are or mobile home parks that are in rough shape. Or, I think with just more affordable housing in general, it has a tendency to be more higher management. How do you keep them from degrading over time? Like having a tenant who just starts parking vehicles in, their front of their mobile home, and, it just starts to become more worn down. What's your process around that?
Yeah, so we do monthly inspections, and we have rules and regulations that every tenant signs, along with a lot lease agreement, that they're buying into, living here long term and being an owner, right? So they need to take care of their home. Otherwise, they'll be given violations, and they can actually get fined if they don't follow suit. And that's something you got to stay on top of, because, a lot of people just, get lazy, and they put the appliance that stops working just out in their front yard. And if you just don't, tell them, hey, you need to take this to the dump, this can't stay here,
Mm-hmm.
then it's just trick. It just, then somebody else sees that and then they do it. And then it just kind of, it spreads, right? So you have to stay on it. You have to hold the community, responsible, hold them accountable to make sure that it's taken care of, and it passes the drive-through test, right? And it doesn't look like the ratty trailer park that you're thinking of. And if you keep it, you'll be able to attract better tenants. If you keep it at that higher level, you'll be able to attract better tenants that want to live in a community, and, keep it maintained. And that's what you want. And then eventually the culture will change, and people will just naturally start to keep the place clean.
Got it. That makes sense. So you don't actually have an on-site person that works there every day, but they come by on a periodic basis to do inspections and that sort of thing.
We do actually have an on-site manager.
Oh, you do?
Yeah.
Okay.
So it's like a part-time on-site manager that'll basically help us issue violations, do the drive-through videos, and basically be our eyes and ears on site.
Nice.
That all the tenants have direct access to. If they need to make a phone call to kind of let them know about something. And then off-site, we have a whole management company with 36 employees that helps us manage all the on-sites and keep track of all the communities. And we get on-site once every 3 months to each of our communities, doing an inspection report, checking occupancy, confirming collections, and so forth as well.
Wow. And that's across 10 states?
It is.
Wow.
Yeah. So it's a pretty big operation at this point.
Yeah, that's interesting. And so how do you find new opportunities and new deals?
Mostly cold calling. We've built a CRM, 9-10 years ago, where we said, hey, we want to buy parks 50 lots or more within an hour of an MSA that has at least 50,000 population. And we only want to buy in an area that has a median home price above $200,000. So we scrubbed all the mobile home parks in the country. There's about 50,000 of them, and we got down to 8,000. So our list of 8,000 leads is in our CRM. We have a full-time salesperson that just calls and cultivates relationships with mostly mom and pops that own these, one or two of these communities, and they're using it as a retirement vehicle. But as they, want to retire, a lot of baby boomers want to retire pretty soon here. They're going to trade hands, and we want to be there to save them the commission of paying a broker, and then also, provide us that first look so that we can get in at a great basis on some of these new properties. And a lot of them, like you said, they have deferred maintenance. They kind of look ugly, at first glance. But the problem is they just haven't had money invested back into them in a long time. They haven't had the fencing repaired because the mom and pops are using these as retirement vehicles. They need that money to pay their expenses. Where when we acquire a new property, we have a healthy budget to reinvest, trim the trees, get the trees removed that are, beyond where they should be, and just make the community safer, right? Fix the roads, improve the fencing. And then again, we want to refinance into agency debt, which is the best financing available. And they're not going to loan on a dirty old trailer park. The agency lenders require you to, make sure that this property has no deferred maintenance and that it's being managed at a high level, or they won't finance you.